Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a Strategy of the Week update here for April 21st, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. So, with all that being said, um, what a good day and a good close we had for the soybean complex, particularly for those soybeans. May soybeans trading positive on the day and trading for a close. They're up a penny, I guess, on settlement, but at 17.48. Pushing into a new high of the day, higher highs and higher lows, continuing yesterday's big, strong, continuation day. A couple days worth of a breakout. Earlier today, we took a look at this chart, this daily chart, the breakout of this trend line here that was right around the $17 mark. Now that we're starting to break out of that area, what's next for the soybeans? We're starting to go into overbought conditions. Talked about this earlier today. I did a live on Facebook. The overbought conditions in the market can remain there for an extended period of time. Back in early February, late January, there we went overbought in the soybean market there. 14.50 is about where the conditions set in. We remained overbought for an entire dollar. So, put that aside. It doesn't really matter yet. Certainly, we know that is an indication we're probably getting closer to a top than a bottom, but a dollar rally from here would take us to 18.50. All right. Last year at this time, it's always, I think, good to remember or think about, past markets. Were they anything like what we've seen this year? Last year, this time, we saw a pretty strong rally into the $14 area for the May soybeans. We started to break above 14.50 and then broke all the way up to $16 and just above there, almost as high as 17 come April through May for May and into June there for this May soybean. We are somewhere right around here, right, where I've got the cursor is around April 20th on this chart. So a breakout of this consolidation, this high is around 1450. That breakout of that area is very similar to, in my opinion, to this year of this breakout of 1750. That we could be seeing here on the charts today. We've got a narrative that supports the continued trend higher here for soybeans. We've got excuse me. We've got fairly weak demand week over week, but the demand has been strong this year comparatively to history. Sorry about that, folks. But we have a tight balance sheet. So when the pile of soybeans that we're chewing away from, even if that demand is a little weaker, we tend to discount that because we're eating away at a smaller stockpile and a smaller year-over-year carryout for the global soybean balance sheet. And that's, I think, a trend we're going to continue to see into this year. It's going to be a driving factor over the next couple weeks. We see delayed plantings here for corn that's going to spill over to soybeans. We see bad weather throughout the United States, and by bad weather, no rain's coming. We need to relieve a lot of that drought condition we see across the United States. If we don't do so, we'll look at that in coming weeks as it develops. I think it's too soon to start talking that narrative because so much can happen. You get a wet May, and all of a sudden we're talking about a very different situation, maybe too wet feet for corn and other things. But that can all change because weather can change. But the narrative as it stands and the progression that we're making is towards a drier year so far. We have a delayed plant so far in terms of what we've seen from our week over week numbers, but that can catch up very quickly too. Nevertheless, we have a tight balance sheet and we're seeing a rally on the board, breaking out of technical levels that is currently, accentuating that. And I think today's price action is a great example of that in the soybeans. 18-day moving average at 1665 here in the May bean. I think it's going to be dragged up here now that we're starting to break out. I think we're on our way towards $18, and I wouldn't be surprised to see that here over the next week and into the start of May. November beans, very similar in terms of a breakout of technicals and of a trend line here against the highs, but we are coming up on the contract there at high at 1550. I'd want to see us rally above there. This is going to be lagging here. We're going to be continuing to expect to see bull spreading here in the calendars in the old crop, new crop. Here it was true, just marginally. Here, if you look at November, was settled up 2.5 relative to that November or being they're up 2.25. So we did bull spread the day by just a bit. But that's something we're going to continue to monitor. I would also say that it may, looking at July here, which is at a discount here to the May bean, July might be the low-hanging fruit here at a 30% discount to May beans, expecting to see, some bull spreading carry through when the roll sets into May and we start to see those sellers roll. July is going to catch up here rather quickly, and we're going to be, that should be happening and really in full swing if it hasn't already. And I haven't been checking the commitment of traders, but I would imagine that it's starting to, we would start to see that trend in favor of tightening that up a bit so that, hey, it doesn't make it as lucrative to roll to July as it should be. So that might warrant getting long July here rather than the May. And that's something to continue to watch for. So let's dial down to the small time frame here, or the shorter time frame here for our May bean. Everything I talk about right now could be applied to July beans, any of our old crop. It's the same idea. I'm drawing from the 17 highs to new highs. I talked about this anchor earlier. It's a 50% fib. It's very similar to the swing low from 1705s here up to the highs at 1750. The pullback here into 1728, 1730 here today was both trend line support. As you can see here, this dotted trend line that we talked about earlier today, as well as the 50% level in terms of the next in the series trend. 2 steps forward, 1 step back. 2 steps forward, 1 step back. Holds, and now we're progressing towards 1760 technical upside targets from those negative 23.6 lines. Yeah, so earlier today we were kind of bouncing off of this level. As we talked, we were, to be fair, up around 1740 already. Yeah, we continued through. We saw the close that we were looking for out of this. I wouldn't be surprised to see pullbacks towards 1740. Could even see a retest to 1730 overnight. That would be very dirty, and very dirty price action would be to actually go below today's low before snapping and reversing higher. But this is the soybeans. Don't discount their ability to cause the most pain. And for the bulls, that would be a great way to cause some pain in the near term for the intraday trader. But otherwise, we're expecting the market to generally stay above $17, even in extreme volatility. And I say that with quotations because, we're talking about the market only moving like, 50 cents here when we've rallied almost $2 since the beginning of the month. All right, so yeah, continuation of the trend higher. Buyers in the dips looks like a good thing. It's very hard right now to position and to take a trade in the soybeans. I'm looking at the $18 strike for May. That is going to, honestly, I hate to say it, but we have to kind of go and you'd have to look at looking at July. $18 calls are still going for about 40 cents there into the end of the day. We can chop down on that cost dramatically by selling, a $19. Now you're talking about a 22-cent cost for a dollar-wide call spread here. 64 days left through July. That's how I would chase this high right now, because at least then I know I get a taste of the upside. If the market falls apart, I can always buy back the short call, roll that $18 call lower. There's things to be done, but I never have more than that original 18 cents at risk if I do nothing. And that's an idea here for chasing, I think, soybeans. And I say chasing because I would love to be a buyer in the dip, right? But I can't sit here in this video and and advocate for a soybean long right now because we just finished basically at highs for the month. By the pullbacks, there isn't a level I would buy right now because I see us in the midst of a swing. So, yeah, there you go. A position that still gets you long in the market has built in a release mechanism, if you will, or the opposing side. If the market falls back a little bit and goes against you because you're long a call spread, here the $18, $19 call spread in the July bean. Again, you're long for 40 cents the $18 call. You're short the $19 call for 18 3/4, and that's just going off the settlement prices. So 22-cent cost, 23-cent cost all day after commissions and everything else you could throw in, and even slippage on top of all of that. You have the potential to make 77 cents of pure profit if the market rallies over the next 66 days, which in the time frame that we just looked at on the daily chart of a comparison to last year, this is the type of spread or a way that you could get a trade still before the train has really left the station for the next, that next bull market that we were just looking at, right? Compared to what happened in May through June of last year and this year, that's a great way of tackling it. All right, let's move on because corn, I think, has an interesting piece to be said for itself today too. Very strong bull market that we've seen in corn. If you go and you look at new crop, you could even argue that we've had a stronger bull market, technically speaking. Look at how many days we were overbought here. Since March 31st all the way through today. The entire month of April has been overbought until today. Today was the first day of non-overbought conditions. So long as we remain, above some key support here, continue to flag kind of at highs, this overbought condition can kind of taper off before the market eventually resumes itself higher. Pullbacks here though on the December corn is $7 is a very, psychological level at this point to be aware of. The 18-day moving average is around 710. The 650 area is the 55-day moving average. I mean, by the time we'd go down to test any of these levels, they'd very likely rise up a little bit. Trend lines, however, I think it's worth talking about trend lines real quickly. Trend lines against the lows would kind of bring up a channel or a supportive area around 680. It's hard to find support that isn't pretty far down right now because of this just arduous, short covering trend that we saw. And really what the last month in corn was, in my opinion, and what I think you can see when you look at the calendar spreads too, when it was December catching up. It was those deferred contracts needing to catch up with our near-term contracts. We had gotten a little too inverted. We'd gotten into way too backwards in terms of the spreads, and those markets needed to correct themselves somewhat here. Wow, my spread. That's unfortunate. I'll have to rebuild that portion of my platform here. I was going to bring up some spread charts or the spreads. We'll look at that. Actually, I shouldn't let that deter me here. Let me just close that and close that. That's good enough. There we go. You see how red and negative these numbers are right now. These numbers reflected something very different in corn not too long ago. Let's see if I can get the forward curve for corn up here. This looks like live cattle. That's all right. What I was trying to and what I was going to express and show you there was that these numbers have all shifted around dramatically over the last several months. And well, actually it had just come up there, didn't it? Down here at the bottom. this line had shifted dramatically. There we go. So you can see May through May of next year and even further out here. You can see how price of corn drops off, right? Well, these all these back months need to catch up, and so it's the tail of the dog, and the dog is leading us here in the front, and the tail needs to catch up. And each of these kind of steps as you go lower is each calendar, each marketing year going out forward. And if you go all the way out to March of 2024, we're still below the 7 handle. Well, those are probably going to get dragged up above 7. And so these spreads can't get too far apart from each other. And historically, there are levels that they stay within. So the market arbitrages them out. Market makers are starting to position that far out. I used to work in this field doing exactly this in spread trading. Grains at an earlier portion of my career. And the idea is to monitor this tail that is being wagged by the dog and get to know this curve, this forward curve, because it's instances like this where we identify when these back months are undervalued relative to the front months, and we need to build carry into the market. And that carry gets built in, which is what we just saw happen up into through now. And now that that has occurred, the market can get back to the inversion and now take those very red negative numbers that you see there and try to turn them the other way. All right, so May corn settling the day just below $8. Could ignite some technical selling here and a little bit of fear selling. Watch tonight. I am fearful that May corn might see a stop slide lower now. It is option expiration, so settling below $8 could ignite the profit taking and sellers here for a technical slide. Below this trend line, the next level I'm interested in is the 770 to 760 area. It's this old cluster of highs. It's where the 18-day moving average is. If we were to break in the corn and head lower, that's where I'd be a buyer. I'm not betting on being short corn into tomorrow. I would use any break in corn to be, again, a reestablished long positions and what have you. In fact, I have been advising long positions here over this last week, and I'm still was doing so even into today. And an interesting way of getting long corn is we could utilize options here at that $8 strike that go off tomorrow. You might be throwing the 5 cents of cost away, but an $8 call was going for 5. It was probably less, maybe even 3 or 4 cents into the end of the day. That little of a cost, if the market rallies 20, 30 cents tomorrow, or you get the option again to be long corn there in May at $8, at tomorrow's close, if that's something you're interested in. There's ways of utilizing that 1 day till expiration, option in, that could become like a future, because if we just go, a penny or two higher, $8 corn is in the money. And everything above there is going to, because tomorrow is expiration, could be assigned to futures long $8 corn. Anything above that is then pure profit in your pockets, less above the cost, of course, of that call, which a couple pennies, 805 corn, and you're pure profit. All right, and again, and that's all at the risk of only the 3 to 5 cents, whatever it was costing you there out of pocket. For the May corn. But an idea of a way of getting long corn today that I was looking at with some clients that I thought was a good way of taking low risk, high reward in the market is utilizing an option that goes off tomorrow in May corn, because we're at one of those important strikes. And the other side of the coin could be taken too. An interesting idea, and we'll get into short-term corn here in a second, the smaller time frame technicals. But hey, for the sake of playing devil's advocate here, if that $8 call was 3 to 5 cents, there we go, 4.5 cents here into the close at settlement. 7.95 put for 2.5. I don't think corn's going to be within 8. I don't think corn's going to be above 7.95, but below 8. I think it's going to be above 8 or below 7.95 by tomorrow's close. So for 7 cents of cost, you could have a a straddle on the market here that goes off tomorrow, and hopes that corn has a day that's up 20 or down 20. And if that's the case, you're probably going to be making, 8 of pure profit after the cost of that trade. And then you find yourself in a futures position. You could put a stop in the market at break even. And if you get stopped, you get stopped. If not, you're in a futures position that has the chance to make you some money. I'm all about minimizing risk, that risk reward ratio, or minimizing the risk and maximizing reward in a with a strategy that makes sense in an environment where it could actually come. Option expiration tomorrow, 1 day left on an option. Leaning on that as leverage. We are leveraging the lack of time in these options. That means a lower cost. We're leveraging that, right, in this idea of being able to spend pennies in a market where volatility is pretty big and have the ability to make some money. If corn's up or down 20 cents tomorrow, an option that's 5 cents out of the money with a 2 to 4 cent cost is going to make you 16 cents of pure profit if you were right. If you're wrong, you're only losing what that option cost. Okay. I still like going out further in time if we're going to be looking at strategies for corn to position, but I like getting long the futures, getting long options like I just mentioned in the very short term, because I think that is a good way to lean on these small or lean on these short or the lack of time left on them in the near term. Okay, so May corn. That 4-hour chart, very bullish still, and very much a pennant structure. Inside day, we are inside yesterday's price action. Much lower though, we break below this $8 mark, this trend line support. Next area of support is 770 to 750, so that 760 mark. Don't see why we couldn't get down there. Full 50% retracement here. From our lows here from 714 all the way up to the highs of 819, or the let's call it an 820 high, but it's 819.75, are at 766 half. Let's be mindful of that. The extension longs here, the extended longs or the supportive levels that we're finding here are at $8 and 794. There's many technicals that suggest that, plus the proven support from the other day at 795. Being a buyer down here on a second test is risky. That's why I suggest using that option where we can minimize our risk. If we were testing this level for the first time yesterday, then we're taking it maybe in the futures with that 10 cents of risk. Now I think the market could be doing a equal legs. So let's go down to that 15-minute chart, because this is a technical that we don't talk about enough. We talk about 50% fibs, but I really like equal legs. What I'm doing is I'm measuring this first leg down from 819.75, and I'm extending that measurement from this counter trend move that occurred. We moved lower, we bounced, and then we started heading lower yet again. If we continue lower, equal legs down is at 793. So again, confluence of our fibs. We've got a supportive zone here that we can justify watching on the charts and maybe even participating in. And then below that, though, the market starts to break down again. We break trend lines, we break that supportive zone. There's nothing again here, in my opinion, until we get down to this next fib, this 50% line, the 766 to 754 area. And there's also this larger upward sloping trend line in that area. So 1, 2 set of supportive areas, and then below us, of course, is that $7.20 to $7 area. And if we just keep going lower, we can find a few others with open gaps, with confluence of highs and lows, and many other reasons. But we're not there. We're above 790 right now, and we're concentrating on what that type of market and environment means for us. So let's keep an eye on things here. If we start to slip a little bit lower, it could become one of those bloody Friday option expirations. If we're flattening on the sidelines, it might be a great opportunity to be a buyer. We've got some good levels to watch. The lower we get, the more ambitious I would personally get at getting some longer dated call spreads and other things on, because if we top out now, before getting a big rally like we saw last year at this time, that if we don't see that another dollar or two higher, I do think that we'd be heading more or less sideways in the ranges that we've been carving out. They might get a little bit wider, so that means I don't think we'll be going below $6 corn, but a $2 range in corn isn't out of the question. And again, breaking out of that $2 range could mean corn going to $10 by the fall if we have a summer month with dog days, high heat July, and a general kill that to the crop that occurs in a different environment and just gets a different narrative throughout the year. But the way we're going now is kind of like last year. I think we're going to be finding support sooner than we think, and then from there continuing higher on many of these charts. So we'll see what happens there. All right, let's take a look at the Chicago wheat and our other wheat contracts, kind of all in one here. And then we'll take a look at the 4-hour charts and, try to make some sense of wheat. It's a pretty choppy market right now. We were in a bit of overbought condition, but have, since pulled that off. So, this choppiness on the stochastic is very similar to the choppiness we have on the market. Both sides have overbought and oversold over the last month and a half. And been on both sides of this 18-day moving average, which comes in around 1060 there in the Chicago wheat. Comes in at 1103 there for the KC Hard Red Winter. Notice a little bit better bid there for the KC Hard Red Winter. We're showing a protein premium building back into the market. And by the way, that KC wheat is more reflective of that international wheat crop that's threatened in Russia and the Ukraine. So European demand for wheat is going to be on that Hard Red Winter more so than that Chicago contract. At least that's my understanding, right? The 11, because I'm not a wheat trader, I don't know if that's still the case, but has always been what my understanding of the demand. Globally, things change, though. I don't know why that would be the case, because KC Hard Red Winter is bread making wheat. The 111 or the 1118, 1120 there for the spring wheat, kind of our most bullish of the wheat still, makes sense, right? This is our crop that is currently, getting affected by the potential planting of which here around the world. So, and has been the one threatened here in the United States with weather and other things too. So we'll see what happens with spring wheat. But the most bullish of our wheat contracts, the 1120 area, if we pull back, I think we should stay above $11, but we'll see. The Chicago contract, though, really failing to get some legs, but I don't know if we'll fall, might fall down for a test of that 55-day moving average, at the $10 mark, and the 55-day at 9, and the 200-day down at 830. I don't know if we're going to get all the way down there to test those levels, but staying above this 18-day moving average in the near term is very promising. And that brings me to this 4-hour chart where Chicago wheat pulled back in a full 50% retracement here to test this, 1050 area, 1052 lows of the day. That's close enough for me. If we start to continue to get a bounce from here, we did come below this trend line, but if we start to get a bounce from here, I'll be a little bit more impressed. The swing higher should take us towards 1164. That's at least a test of the 50% area off the highs, from the high to low here, from 1363 high to the 982 lows the market made. So, okay, even if it's going to turn over and become a very big bear market and kind of be the highs for Chicago wheat for the year, and maybe they're already in place, and maybe this is our kind of a springtime high forming for the year, and we enter into a bear market. My point is that going into that 50% short would be a logical thing. So even in some of the bear, counts and scenarios and ways that we had lower, wheat could head higher in the near term. And when we consider, the KC wheat, which I think this year we might switch over to kind of paying a little bit more attention to that in the day to day, because I'm in it. I like the idea of the higher protein quality. I like the idea of a protein premium. I don't personally understand the dynamics as to why over the last few years KC hard red winter wheat contract got hit so hard, which, a contract that has always historically been at a premium to the Chicago, went to a discount to the Chicago for a while here. And, it's finally back on track to historically, the spread is back to what historically I have always known it and understood it to be. So, there's reasons for that with, demand, global demand and what have you, but we've certainly seen in the last several years a reversal of that trend in this last year with the conflict in Russia, now outright inflation. Full 50% retracement would be into the $11 mark, so I'm watching that if it happens. I don't know if it'll get there. The last swing, a full 50% retracement we just traded into 1132. If we start to go above, trend lines against this high and what have you, wheat I do think will continue higher. But man, KC wheat starting to look like a bit of a channel trying to form here, coming off of a low after breaking out of a high, and kind of a corrective structure. This looks like the start of a bull trend. So I'm a buyer in this dip in many regards. I would be looking at, potentially to own maybe some $12 calls. I think that could be a very interesting place to position here in wheat. Again, I'm shifting focus towards KC wheat. Spring wheat into September, okay, that makes sense too. But I'm going with the slightly more liquid contract, right? We're trying to get to play the best of both worlds here. And I'm going into July to give myself some more time. The $12 call here, 54 cents. That where we traded last, that's not really an accurate price, but we can call it 50-cent cost here for a $12 call. The idea is we can go right out to the 13. Here we go, 13.50. So we can get a $1.50 wide call spread for about 30 cents is what I wanted to see, right? Because we can bring in about 20 cents for that 13.50 call. That's what I wanted to look for, is that 5-to-1 risk reward ratio on a KC wheat spread. That's about 60 cents out of the money with 60 days left on it. If we think wheat's going to rally to $13, get to head higher, this is a good way of capturing that price move, limited risk in a volatile market that has the ability to achieve that type of price movement. This is one where I think it's at. All right, so before we wrap up today, I did want to give a little bit of time and talk about kind of a weird contract that I haven't looked at. And I say weird, it's not. I haven't looked at rice in a very long time. Specifically, we're looking out to the September contract. The near term really is what needs to be traded because of the lack of liquidity in rice. But I do think that this is a very technical moving market right now. Let's bring up that daily chart that I was looking at, because the 18-day moving average is one of those markets that really or one of those indicators that always grabs me. Even in this extreme volatility where he sold off from $17 down to $16 2 days ago, that 18-day moving average held strong and in what has been an otherwise pretty sizable uptrend. But rice, like many softs and still like a true row crop commodity. You can see the May contract on the left there, hardly moving around, but starting to really get some activity under it. What I'm pointing out is that we're starting to really see some activity in these contracts, some volumes coming in some less than liquid markets. I'm not advocating trading them. I'm just saying that it's interesting that we're starting to see activity in a market that September rice is on the right. You see how much September rice, trended um, for the month of February through March. You see how choppy March rice is on the right-hand side there. Breaking out of that $17 threshold for rice is probably a very technically significant level. I would say that based off of what we're seeing in rice right now and how illiquid rice is, that above $17 represents probably an area that a lot of the shorts in the market are going to start getting really squeezed at, right? It's above everyone's short price at this point in time. So that's an area, interesting area to watch. It doesn't matter if you're looking at September or May in rice right now, above $17 causes every short losses. And that's an interesting concept to think about. Um, Makes me kind of want to look at owning a $17 call if you can, but there really isn't much of a market on any of that. But I'm just pointing out some findings in markets that are starting to get activity and interest because all of our other foodstuffs are starting to go and get interesting as well. All right, I want to wrap the day up here by taking a quick look at our cattle markets, and then I'm going to get out of here. It's a gorgeous day out. I'm going to go for a walk with my new baby boy, and then go for a run myself. Live cattle in the June contract breaking out of consolidation here for the last couple months, heading above the 138 figure, breaking above trendline resistance. And arguably setting up in a move that could now start another leg higher. We're now above all of our daily moving averages. We are back in overbought conditions, but we know that overbought conditions can remain that way for longer than anyone can stay liquid. You can see here how from a technical perspective, the market has broken above trend line. Equal legs down at this point shifts a little bit because we have a new leg higher, so I wouldn't be surprised if we rolled over. But while we're above 138.50 and above this high, I think we're in a technical breakout, and honestly could achieve this 2 steps forward, 1 step back, upside target of 150 on the June live cattle. But in the near term, there is a lot to chew through here up at highs, and we can't argue with the fact that this does look like 3 waves up right now, in 1, 2, and 3. 140 would be equal legs up, and if we do roll over here, basically before highs, we can justify a downside target there to 127 as well. But generally speaking, I think that the market is breaking out of resistance at this time, or at least setting up into some kind of maybe even head and shoulders pattern, or at least today was confirmation, in my opinion, of some strength in the market or sideways, price action. The bulls are in control. It's their ball to give up, is my point. All right, and in lean hogs here today, trading pretty sideways. The June contract looks a lot like a head and shoulders pattern here. Neckline's down around 111, left shoulder, head, right shoulder. We're fading now back below the 18-day moving average. I don't like this price action. I was very, very optimistic that we were breaking above and we were going to continue to rally higher. This is actually what the chart I'm worried that that June cattle might become, right? If this starts to roll over and head back down, that's exactly what's happened here. You see that? This is the move up, and we're rolling back over and down. It's a little bit of a different time frame, but it's a similar idea. It's a kind of failure to get momentum higher or continue that momentum higher. Anyway, we're still very much in a range. So above 115 and above this low here at 112, I think we're still very range bound for the June lean hogs, but fading off of that 122 area, back below the 18-day moving average for a test of the 55-day here at 117. We break below. Man, it's going to be, at some point, I feel like we just need to flush out and head lower. 100-day moving average would be down around 108.77 and 101s for that 200 days. So. All right, everybody. I hope you've enjoyed this week's Strategy of the Week webinar. Came at you earlier today with a quick live stream to kind of catch you up midday. We had the close that we were looking for from that report, and I do anticipate row crops to continue with the strength we've seen. Again, they're going to do what bull markets do best, which is, pull back after making new highs, after every new contract high on a day, week, month, all of those term bases. We seem to get those pullbacks. Corn is susceptible to them. I think we're in the midst of, a pennant and a kind of a consolidation there that hasn't ended. I think soybeans are gearing up for that breakout and might be going for the title here and now. So that's something to watch here above the 1750 figure. How high can this thing run? But again, every day we're going to be met with 40-cent rally, 20-cent pullback. Don't be shocked when you see that volatility. It is all part of a bull market and what bull markets do best. So thanks for joining me again, everybody. Shoot me a line at 312-277-0110 with your questions and your comments if you want to discuss taking any of these ideas and making them into more of a trade plan for you. Anyone over here at Zaner is always ready and able to talk to you about your risk management and trading profile. You can shoot me a message there on Twitter, find me at Facebook, or shoot me an email, dhussey@zaner.com. Have a great day, everybody. Have a great weekend in case you don't hear from me tomorrow. But I do think I might be coming at you with another video because we're in the midst of trending markets, and every day there is something to be said. So have a great day, everybody, and we'll be back with you when price action develops. Take care, everyone.